So thanks for joining us.
Great to be here.
So you're atop the private equity business at Blackstone. You've
Kind of
had
in the middle
in the
layer
middle,
with
right.
lots, yeah.
But you have spent about roughly 20 years
20
at
years
the
at
firm,
Blackstone, yeah, in July, yeah.
and you worked in London,
Mhm.
and that was really I wanted to start there in part because it's kind of where you sort of made your bones in a
Yeah,
lot of ways. Did
it's
a
true.
couple seminal deals for the firm, Legoland, notably, and Merlin,
Yeah.
and all of those.
hmm
As you look back to Europe at this point, what do you see? Let's start there.
Well, when I moved there, it was November of 2001, so you didn't even have the single currency yet. And the private equity market was nascent, really. I mean, they called it venture capital. Firms like Permira were called Schroeder Ventures. Cinven was this small little venture-oriented firm. And we were investing out of a $3.7 billion fund at that time. And so it was really the early days of private equity, not just in the United States, but in Europe. It was the very beginning. So we got lucky, really, and we were. I basically looked at what had succeeded in the U.S. up to that point, and it was largely in highly fragmented industries that were undergoing consolidation, creating market leaders out of small mom and pop businesses. And so we pursued that strategy largely in the UK and Germany, which were the two most receptive markets, I'd say, to private capital, and the most predictable, and where the capital markets were the most well established. And we consolidated pubs and nursing homes and hospitals and theme parks and visitor attractions. And so that it was really just trying to figure out what had worked in the U.S., applying it in those two economies mainly. And we had really the wind in our sails in terms of the development of the private equity market, the development of the capital markets, particularly the debt capital markets in Europe, and enormous economic growth that we all understand now in retrospect, driven by the enormous subsidies that were being transferred from Northern Europe to Southern Europe, and the overall economic growth that Europe had enjoyed in that first decade of the 2000s.
So now you're back here. How are your partners feeling about Europe right now? What are they saying back to you here?
You know, Europe has great businesses, and we are fundamentally micro investors. We spend time thinking about where we are in cycles and geopolitical events and GDP growth. But at the end of the day, we got to buy a good business, and we got that we can do something to and pay a reasonable price for it, and make sure that the business has some sustainable competitive advantage. And there are many businesses that fit that bill in Europe, in Germany in particular, in the UK and Northern Europe, also good businesses, although fewer, I'd say, in Southern Europe. And so it is definitely a stock picker's market. There's no more of this big wind in your sails, economically, valuation-wise, the expansion of capital markets. All of that's probably going slightly in reverse, as the banking system is still under enormous pressure, with the ECB throwing a lifeline as really the lender of last resort to the big financial institutions in Europe. And I don't see that changing anytime soon. So the bar is higher now to invest in Europe. You have to find really good businesses, pay a fair price. It's harder to get large-scale deals done in Europe than it is in the US. It's very hard to do public to privates because of the takeover code. You need 90% of the shareholders to tender, or 95, I think, in France. In the UK, you need 75. So it's really a middle market compared to the US in private equity parlance in terms of size of transactions.
And how are valuations globally? How are you feeling about them? How expensive is the world right now?
It's extremely expensive, historically expensive. And we're subject to that, and we have to navigate within that. Fortunately, we're only making 12 investments a year, roughly, globally, out of our global buyout fund, across 5 key geographic regions: U.S., Europe, India, China, Australia, and now Japan. And we have 140 people out in the world trying to source transactions. So I think we're able to find those 10 or 12 interesting idiosyncratic situations, but there is not a single industry or a single country where we say it's time to buy, the wind is in our sails, the valuation environment's going to only improve. I think we have headwinds on most of the key industries we look at. with the exception of energy about 18 months ago. But that's come roaring back, and in most of the geographic regions we invest in.
And when you think about possibility of a recession globally and in the U.S., how worried are you that that is looming, and what's the timeline you see?
Well, looking at our 90 portfolio companies and the data we get monthly from them, I would say that the economy globally is in rude health, and I don't see any signs of that abating anytime soon, meaning in the next quarter or year. The expectations of our CEOs is for continued strong growth. The industrial rebound in the United States since 2015, and that really, the industrial economy in the US didn't really rebound much until 2015. And we now have businesses that are growing their top line at 8 to 10% that are traditional GDP growth businesses. So we're above GDP trend in US industrials. I think European, also particularly German industrials. Consumer businesses are more on trend, kind of 3-4% real growth, maybe 5-6% nominal growth. And I don't see that changing anytime soon. I think the risk to this vintage is less when a recession comes, because it will, but I don't think it'll be anywhere near the same severity or magnitude as the 09-10 recession. I do think, though, global cost of capital is poised to increase rather significantly, which will affect credit spreads, and obviously the 30-year Treasury rate, which has already moved up, PE multiples. That, I think, will be the risk to this vintage, where people bought assets assuming they could sell at the historically high multiples that they paid, and that won't necessarily come to fruition.
How much are you worried about the amount, you mentioned your global private equity fund, how much are you worried about the cumulative or collective dry powder chasing deals at this point?
I'm worried less about that, honestly, because the benchmark valuation is always the public market comp. It's not really whether you have 8 or 10 people in an auction and whether or not the 8 people in the auction have a fund that they've just raised. That doesn't enter into our thinking. One thing, though, that does make the environment more difficult, and it does relate to the availability of capital, as I heard Jonathan say, and I agree with the simplicity of the supply and demand, is that you have buyers in our market that weren't there a decade ago that think this is easy. So whether it's our own customers in some circumstances, our limited partners, yes, family offices, people who used to work at a firm like Apollo or wherever raising money, really credible people who probably will get capitalized, but maybe only know a bull market. And so we're seeing incremental competitors, incremental firms coming into our market. Or there was a while there where Chinese firms were acquiring assets and competing with
some of your assets, as a
firms.
matter of fact.
And we were all beneficiaries of that to some extent. But also they were competing for assets. So that I view as the bigger issue than whether or not the guys you had up here earlier, Bain and KKR and Carlyle, who are super rational, super disciplined investors, whether or not they have more capital to invest or not.
One of the issues that has been a theme throughout the day has been how public investors view private equity firms. We have a chart here behind you that was there, right behind you, and disappeared at exactly the right time. The public markets. Oh, there you are. Thank you. I just wanted to make sure everybody's paying attention. Steve Schwartzman has lamented on this stage the fact that the public investor writ large has not totally understood private equity. What are they getting wrong?
Well, I mean, I'll start by saying my mission and mandate is to invest our private equity funds well. So if me and my partners and the team of 200 odd people who work in this great business do our job well, then that price will go higher. And so it's hard for me to understand exactly how the market views our stock. I'm not sure. I mean, I care at some level because it's my biggest asset personally, but I think about it over the next decade. And if we do our job well, I think that the fact that these firms trade at pretty low multiples of their cash flow should change. I mean, I think but we're still in like a show me moment as firms. All these firms as publicly traded stocks, and so I think it'll work out if we do our jobs well.
So, speaking of public shareholders and shareholders in general, one of the probably the single holy grail, it feels like, for a lot of private equity firms or alternative asset firms is access to retail investors of some sort, whether that's into 401ks or IRAs or some other method. How far along are we in that, and what's the next step forward from a Blackstone perspective?
I think retail's exposure to illiquid alternatives is virtually non-existent. Certainly not in the 401k area,
Right.
Defined contribution, which is a big thought piece that my partner Tony James and former president of Blackstone has been driving. And I think it's inevitable that it will change because having an allocation to private equity and private credit and other things, I think would better balance people's individual portfolios. There's no reason they shouldn't have exposure. It's harder to access retail money for my type of business, which is quite illiquid. You commit capital, we invest it over 5 years, and we return it over the following 7 or 8. And so you invest $1, and you'll see $2 or $3 if we're really good net over time. But it's a long time from now, and you can't get it back until we send it back to you. So it's not the perfect product. What I do is not the perfect product for retail. Although I think there's a percentage of everybody's portfolio that should have exposure to that because
because theoretically, like I'm not. If everything's okay, I'm not going into my 401k anytime soon.
Correct.
So.
You're not pulling money out of that. And there are benefits to private ownership of assets. We can attract great talent, make better capital allocation decisions than public companies can, control the exit, which is important. When the markets are down and people are withdrawing money from mutual funds and ETFs, you have permanent capital impairment. We never do unless we make a bad investment decision. We are never going to sell a viable company at below our cost ever. Why would we do that? So there's lots of good reasons for everybody to have a private equity allocation. I think it's hard because of the illiquidity. But I think that'll change over time. And then there are other things we invest in, like real estate, corporate credit, liquid alternative strategies that are gaining enormous retail momentum as we speak and attracting lots of capital. Our firm's very well placed to manage that money because of the competence we have in real estate and credit investing. I think private equity will be a longer road until we start seeing meaningful flows of retail money into what I do.
And when you think about shifting to the private side and your big institutional partners, your limited partners, be those sovereigns or pensions or family offices or whatever, you mentioned them as competitors to some extent. How does that play out over the next few years? Does that get more competitive? How does that relationship evolve?
I don't think so. I would say we are in business to serve our large institutional capital providers, which are the state pension plans in the U.S., sovereign wealth funds. In large part, that forms the core of our investor base. And the most sophisticated of those who like to make direct investments realize that we are a great partner and can help fulfill their mission of deploying capital on a direct basis. So you take the last couple of really large deals we've done, have exceeded the capacity of our fund in a single exposure. We don't really want to put more than 10% of the fund in a single deal. So if we have a $4 billion equity check and the most I want to put in the fund is $1.8 billion to $2 billion, we need a partner. And we call on these large sovereign wealth funds and state pension plans to provide that capital. And so we're able to manufacture opportunities that they can't on their own, and they realize that.
Right.
So when they do compete, it's more in plain vanilla sort of situations. And I think they view us as partners, and we view them as our lifeblood. They are our partners in this business. Without them, we don't exist. And so I think we have a great symbiotic relationship, even with the firms that you would deem as sort of competitors in certain circumstances.
So as you look over the last 10 years, say, and certainly since Blackstone went public in 2007, based on assets under management alone, Blackstone has really distanced itself from its closest rivals, in part by diversifying. Two questions come from that. One is, how did that happen? What was if there were a couple catalysts, what were they? And the second is, how does private equity, as part of that, remain relevant and important, given that part of what drove that was diversification?
Well, when I started at Blackstone 20 years ago, we had a private equity business, a real estate business, a corporate credit business, and a hedge fund business, which is exactly what we have today. So diversification was not something that we alighted on when we went public in 2007 or after that. Each of those businesses is now much bigger.
Because private equity, when you joined 20 years ago, private equity was much bigger than
private equity was, as I said, we were investing out of a couple of $1 billion fund. We had a $1 billion real estate fund. We had I think it was a $900 million mezzanine fund, and we had $300 or $400 million in what we call BAM, which is our liquid alternatives business. They're all now obviously way bigger. Private equity was the largest and most profitable, had the most people in that moment. Today, we have roughly the same amount of assets in each of the four businesses. Real estate's a little bit bigger. And that just was the DNA of the firm. Steve believed that Steve wanted to build an enduring institution, and he wanted to build an institution that was diversified and that could take advantage of opportunities when they came up across asset classes. And so our real estate business was born out of the savings and loan crisis in the early 1990s and the Resolution Trust Corporation, where we bought a bunch of assets, which is when John Gray started, who now is the president of the firm, and built the real estate business from what it was to clearly the market leader. We can talk about how that happened, but it really accelerated in the post-crisis period. And credit was always a very important part of what we did, and it was accelerated again with the partnership of an acquisition of GSO. So private equity, however, remains, I think, the core to the franchise and the highest profile in terms of the types of companies we're buying, and where we have potentially the most risk of things going wrong. So the amount of attention paid by the senior people at the firm on this business is enormous. And if we do it right, it should be the most profitable of our businesses, because we should be able to compound over long periods of time at 20% plus type gross returns. So the multiple of money and the carried interest that comes from this business will always be the bedrock, along with our real estate opportunity funds, the bedrock to Blackstone's profitability. So we are as important as we ever were. Meaning we, the small we, the private equity business, as we ever have been to the overall firm.
And just got a couple minutes left. How are you feeling about returns at this point, given where valuations are, given the state of the market, given competition? How much danger is there that returns sort of start to wane a little bit?
Well, there's a lot of danger. I don't think any of us are willingly underwriting in a base case returns to low levels. Or even lower levels than we had been historically. But the degree of difficulty to achieve those returns is higher now. And so the risk that you don't achieve it is also higher, and therefore the expected return out of the median private equity deals probably lower than it was a decade ago. Obviously, I believe, and if I didn't, I shouldn't have this job, that we can continue to generate the same types of returns. We've built our organization in a really profound way to be better stewards of businesses, better industrialists. We have our portfolio operating intervention effort, which has 50, 60 people engaged in it, is robust. And every time we buy a company, we have a really specific set of actions that we're going to take to improve, under our control, to improve the business, to help realize these returns. If we don't do it, we're not going to generate the same types of returns as we had historically. But I believe we can. And the investment we've made in that is really critical to the continued generation of good returns.
I'm going to follow the very good example that Scarlett Fu set just before us and end on time.
Great.
Joe Baratta, thank you very much for joining us, Voya Sachs. I appreciate it. Thank you.